Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and he's also a CPA. He has his office in Lafayette, California. He practices in the area of taxation and estate planning, financial problem resolution, and 1031 exchanges. He is a certified specialist in taxation law by the California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. Scott is a past president of the East Bay chapter of the California Society of CPAs. So thank you for your service, Scott. Anyway, in a past life, Scott was a sports writer. He covered Major League Baseball, National Football League, and other sports. So, Scott, thank you for being my guest today. Pleasure having you with me again.
Good to be here.
Okay. So, today, I mentioned that Scott is a qualified intermediary for tax-deferred exchanges. He also does a lot of teaching of continuing education classes on tax-deferred exchanges for CPAs and attorneys. And so he and I are going to talk about tax-deferred exchanges today, or what also called Section 1031 exchanges. It's one code section that a lot of people seem to know as opposed to many others.
Right.
So as we get started with this subject, I do want to caution you that it is a complex tax subject, and so we're not going to be able to cover everything in a half an hour that you need to know or that needs to be known. And so you need to get professional help when you're involved with one of these exchanges. It's one of the times where really it's probably essential. And so we do want to encourage you to get that advice. So find a good tax attorney, tax CPA, enrolled agent to help you out. Scott, let's get started. Okay. Well, gee, this has been a tough time for real estate. Are people still doing tax-deferred exchanges?
Yeah, well, we have our fair share, I think, in our office as intermediary, and of course then with all the teaching I do, I get calls from CPAs all over California. And what did you mean when you said that kind of thing in the classes? But we have our fair share. One thing I'm noticing is that there are properties being held for a long time that still have some gains in them, and that's really the key. The old days being 5 years ago, the exchanges were happening every day, and we were rolling, and what was happening is basically the values were much higher than the tax basis. So if they sold the property, there'd be a taxable event, a pretty serious liability. Now with values declining, of course, the exchanges have decreased in volume as well.
Yeah, okay. All right, so what is this thing called a Section 1031 exchange?
Well, the historical perspective is that when you're in business or an investor, you have this asset, and the most common thing we talk about today is real estate. But there's this piece of property, and if you sell it, you sell it, you pay taxes. So a long time ago, probably in the early 20s, there was a rule about you have to pay taxes when you get rid of something. But what was found was that farmers and other people similarly situated would trade. They would trade cattle, they would trade equipment, they would trade land or other kinds of real estate. So this is not just real estate, but it could be non-real estate property as well. And because the philosophy was that they were continuing in business or continuing with this investment, the tax code was punitive. It shouldn't really cost them. They could just trade, move on with the next property, and not pay tax. And that's kind of the idea.
Okay.
And that continues, of course, through today.
Okay. So, in a sense, then, for real estate, what is considered to be like kind?
Okay, well, the statute itself has three requirements. It requires that the assets being exchanged are investment property or property held for business. It requires them to be like kind, and it also requires there to be an exchange. Those are sort of the three essential elements. Like kind for real estate is very broad. So I get a question oftentimes from taxpayers. They'll say, well, I have an investment duplex, residential, but I'm tired of tenants and toilets and I want to get involved with commercial property, but it's not like kind. I say, yes, it is. It's absolutely like kind. It really doesn't, it's not the type of property, it's the fact that it's real estate basically, and the fact that it's investment. So you can have raw land for building, you can have commercial for residential, you can have retail for office, you could have a lot, all these different permutations. You can trade, give up one and get two, you can give up two and get one, 3 for 2, this type of thing. So it's very, very broad.
Yeah. So the thing about real estate, I think, because as you said, other types of property can qualify for tax deferred exchanges, but for other types of property, they have to be more similar
Correct.
in use and so forth. Where real estate, it can be like you can exchange a hospital for, a hotel or whatever.
Correct.
Yeah.
Yes.
Okay. Well, can an exchange result in taxable income?
It's possible. The tax code allows for it. We say an exchange. If I gave you my car and you gave me a horse in return, that would be an exchange, but it would not necessarily qualify as a tax deferred exchange because they're different properties. So that's an exchange. So what would happen if I gave you a property worth $1 million and you gave me a property worth 800? Do you think I would stand for it? Of course not. I'd want to be compensated for the difference. So you'd give me money in addition. Well, money is property, but it's not like the real estate. So therefore, that's what they call the other property, or sometimes called the boot.
Yeah.
So you're giving me the boot to, not to get rid of me, but you're giving me the boot to balance out the trade, to make sure the trade is economically equal. But in my receipt of that, that's considered a taxable event because it's not like kind to what I gave up.
Yeah. Okay. Now, how do liabilities fit into this?
Well, the tax code, in a technical sense, the tax code treats liabilities like money. That's really how the text reads. But let's talk about a real world example. Let's say I have a property worth 100 and there's a loan of 70 on it. So I've got 30 in equity. Okay, so I give up that property. The code says that what I'm really doing is I'm giving up the property and I'm receiving, temporarily, I'm receiving 30 in cash and I'm receiving 70 in liability relief. But it treats the liability relief like money. So I'm really sort of receiving 100 in cash. Now, in today's exchanges, we have this thing called deferred exchange or delayed exchange. So it's not really an exchange. If I sell you a property, I have 180 days to go out and buy another property from someone else. So let's say I transfer this property to you for 100, and my loan got paid off, my 70 loan got paid off, my 30 I put aside here in this exchange trust account. And then I went out and bought another property for 150. I used the 30 for down payment, and I put a new loan of 120 on it. That's the 150. So certainly I've gotten the benefit of loan relief of 70, and I've gotten this 30. But in exchange, I gave all that up. So I've got a detriment that's equal or greater. So to answer your question, in that scenario, I'm not really going to get net money or net debt relief. But it's possible that if I get a debt relief and I don't go back into debt with the next property, it's possible that I've deemed to have received money. So if I only put in 60 debt in the next deal and I had 70 on this one, I've got a net of 10.
Right.
And then without money in my hand.
Right.
So I still have a taxable event.
Right. So that's one of the reasons, again, why it's a good idea to get together, I think, with a tax professional. They'll look at the whole deal with you. And frankly, somebody probably is going to end up with debt relief, in many exchange scenarios.
Well, let me give you a real common example, and I just love this. First off, real estate agents have a real big advantage over CPAs and attorneys about tax advice because their rates are free.
Okay.
But then the second thing with that, you get what you pay for.
Uh-huh.
So let's consider a guy who's got a 300 loan on a property worth 900. He sells it into an exchange, and the agent says, well, you just want to trade your equity, your 600, and he takes the 600 and he buys something else for 600.
Yeah.
and he got no money, so he
Right.
doesn't know any better, and he thinks, well, geez, I got no money, I
Mhm.
traded my equity. Well, that taxpayer has a 300 boot,
Yeah,
300 other property,
300,000.
and now he's in serious trouble,
Yeah,
even though he's got a free and clear property.
Right. So you could owe a tax and not have the money to pay it.
That's correct. That's correct.
A little scary, folks. So again, good to be aware of. All right. So you mentioned a little bit of this. Let's define maybe a little better. So what's a deferred exchange and what's a simultaneous exchange?
Okay, simultaneous exchange is real easy. The most common example is a car trade-in. So I have a business card. Let's say I have 2 cars, one of which I use for my traveling salesman job, 100%, just for sake of discussion. It's got about 1 billion miles on it, and I take it into the dealer, and I say, I want a new one just like that. And I give him this one, and he gives me the new one, and I probably have to give him some money.
Right.
But in effect, I've effected a trade.
Mm-hmm.
So I gave this property up, so ordinarily that would be taxable, but in this case, I got a car in return, so that's tax-free, at least currently.
Mm-hmm.
That's simultaneous. That's the most common example. The deferred is most common in real estate. So I sell a property today, and then I have, per the code, I have up to 180 days to buy a replacement property. And there's there's other requirements, but I'm simplifying this. So I sell this property to you today for 100. In general, I got to go out and buy something else within 180 days, probably for 100 or higher,
Mm-hmm.
to avoid taxes. The seller of that property doesn't know you, has nothing to do with this other transaction. It's a completely separate event. It really is a sale followed by a purchase.
Mm-hmm.
But the code and the regs and all the rules that have developed over the years call it an exchange, because the whole idea is that I'm giving up something and I'm going back into the same kind of like-kind property.
Right. So when I first started in public accounting back in 1974, all of the exchange transactions were simultaneous.
Right.
And then there was a court case,
Starker.
the Starker decision.
There are 2 Starker cases.
Yeah. So anyway, so that's what led to this. In fact, basically they left the IRS with a big problem, and so they went to Congress to solve the problem by basically saying, you have to have this thing done by the time you filed your tax return.
Right. The original Starker case was they gave themselves 5 years
Uh-huh.
to find the replacement property, but there's a lot of administrative issues with that, and makes
Yeah.
it difficult for taxes. So we have this 180-day rule.
Okay. What's a reverse exchange?
Reverse exchange is a situation where I've been talking about, I sell you this today and then later go buy something else. Well, this is I go buy this other thing and then later sell you what I own.
Mhm.
And you still have that same 180-day time frame.
Yeah.
And there's a specific safe harbor and a way to do it. And I always say there's a right way and a wrong way. There's a right way to do this, and the IRS has it all laid out. It's been around for over 10 years,
Mhm.
and it allows one to buy the replacement property ahead of time, to buy it before selling.
Basically, you have to borrow some money in order to make this whole thing work.
Yeah, there's a lot of financial complications and challenges, but for the right investor, it really actually works out quite well.
Okay. What are the requirements for identifying a replacement property?
So in '84, when the Starker rule was put in, this delayed exchange, I said 180 days to buy it. Well, if I start an exchange today where I sell you a property and I'm going out to finish my exchange later, I have to identify my replacement property within 45 days of today, and that simply is a writing that I sign as the exchanging taxpayer and give it to my intermediary within the 45 days, post-market in that time frame, et cetera.